Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It is the 5th of April. It's actually the first trading week technically. Well, technically, no. We actually had the first, I think Friday was April 1st. So actually, this is technically the second week of April, if you want to get technical. The market's going to open up in about an hour and 19 minutes or so. We're here before the opening bell, and I want to tell you what to look ahead for this week and for today's session. Now, as far as the news this week, we've got FOMC. That is one of the biggest reports. GDP and FOMC are the biggest reports from the Fed. They are reports that we get quarterly, and we're going to get an idea of where we stand in terms of the Fed. That's what the FOMC minutes are going to tell us. So the FOMC minutes are not as important as the actual FOMC meeting, but the minutes tell us what they discussed as an afterthought. And again, this is following through. We already kind of know what the Fed is going to do because this Fed does not keep big secrets. The big reports for the week, again, is going to be the jobless claims and international trades and goods and services. This is going to give us a good indication that there's inflationary pressure on imports and exports, which is very, very important. And then we have the jobless claims, and then we have the producer's price index, which with the international trades and goods and services will give us a good understanding of where we stand. Now, the big report of the week, aside from FOMC minutes, again, minutes are, we pretty much know what the Fed is going to tell us. This Fed cannot, I'd love to play poker with this Fed. They just can't keep a straight face. But the jobless claims has me worried again. Why? Well, it's like a tease. Every time we get below 700,000, we go back up. We went below 700,000. The 4-week moving average is now 719. And what happened? The prior claim was back in the 700,000 number. Not really, really good. I want the number to break below 700,000 into 600, which we had the week before, but then it went back into the 700. Last week we had, I think, 680 or something in that ballpark, but I want to see it go into the low 600s, not into the low 700s, which is where we're at right now. Keep an eye on that report. It's happening on Thursday. Now, in terms of the overall stock market, we're going to open up substantially higher. The Dow's up 200 points. The NASDAQ is up 70 points. But what is interesting is this, and this is the first time I see this in a few weeks. Look at, so NASDAQ is going to open up higher, right? But look at the bond market. The correlation, look at this. We're going to be down a full handle. So it looks like the correlation between bonds, the long bond, and NASDAQ is wavering. And that's very, very positive because we don't need to see that. Because look, the NASDAQ has been going down and the bond market's been going down because yields have been going up. But I think we're going to stop seeing that, and I think we're going to see some reprieve from the bond market. I think we may see some sideways trading action. I think the fact that we went from less than 1% yield to like 1.7, 1.73 right here. Remember, there's an inverse relationship between bonds and interest rates. Is a bit too much too fast. Now, we're only in the beginning, and I mean the first 5 days in the new quarter. I think once we get further in the quarter and maybe further in the year, we're going to see bonds go lower, but not quite yet. I think for now, bonds are going to kind of drift sideways for a while, especially after this long downside trend. I would be surprised to see us breaking below 132.75 on the TLT, which is what we're looking at, which is the long bond right now. So if you trade futures, and if you want to have a transport, not a transport, but a kind of a transposing vehicle, transposing, not transforming vehicle. Sorry, it's a little early in the morning. TLT is a really good indicator for that. And again, we're seeing it down quite a bit, as you could see here before the opening bell. But if you look in the indices, the NASDAQ is higher. So there could be a deviation between that lock correlation that we've had, and NASDAQ is turning higher, which is very positive as well. Now, if we were to look at the global market, let's go through the global economy, and then I'll tell you guys what to focus on today and so forth. So, Wall Street rose on record optimism that the spread of COVID vaccines might allow global businesses to return to normal. I'm hoping that's the case. At least that's what the numbers are showing us. It looks, and again, I don't want to jinx us. I'm superstitious. But it looks like the worst is behind us. Thank God. We got through that first quarter, and we did it fairly well. Now, the stimulus had a big impact on it, and I thought we were going to go below the 200-day line, but we're not. We're not past a really negative stage just yet. Wait till I show you momentum levels. Investors have been encouraged by the spread of the COVID vaccine despite rising infection numbers in the United States and Europe and other places that have prompted some governments to reimpose travel and business curbs. I'm going to be honest with you. I'm just not seeing it as much as it was 2 months ago. The threat is just going away. Almost everyone I know has gotten their shot or is in line of getting their shot. I'm not hearing horror stories from the hospitals anymore. It really does look like the worst is behind us. Friday's closely watched U.S. government's jobs report, which we talked about a little bit earlier, showed American employers added 916,000 more jobs than they cut last month. That's promising. That's well ahead of the forecast of 617,500 and nearly doubled February's growth. And that's why I'm hoping that the jobless claims this week are going to reflect that. Now, here's the interesting part. Friday, the yield on the 10-year note, or the difference between the market price and the payout, rose, which means bonds fell. This is what it's telling us right here. That it just kind of went up a little bit, the yield. And let's go back to this right here. The yield that has risen sharply this year, drawing money out of stocks on expectation that revived economy activity will cause inflation to rise, reducing the value of the payout in real terms. And that's what I'm talking about here. Remember, folks, there's a negative correlation between the stock market and interest rates. So not stock market interest. There's a negative correlation between bonds and interest rates. When bonds go up, interest rates go down. When interest rates go down, bonds go up. Now, when interest rates go up, it's negative for the stock market. So there's also an inverse relationship between interest rates and stocks. And when stocks go up, bonds yield usually goes lower. Why? Because investors want to get the most amount of money for the least risk and the most amount of return for their investment. And when you have volatility and uncertainty in tech stocks, which give us the highest return, investors tend to flee to the bond market. Now, we've been talking about that for the last few months. And again, right now I'm expecting a choppiness. And based on what I'm seeing today, I'm seeing less correlation, less of a lock between the 20-year and the NASDAQ. As you could see here, the NASDAQ is up 63. Now, let's look at the QQQ by itself. And now it's at a strong buy again. And let's see if it's above the 50-day moving average. Let's see here. Yeah, we are now, let me just put this study on here. And you could see that we are now above the 50-day moving average for 2 sessions, which makes the NASDAQ bullish. If you look at the SPY is now way up, making new highs. But if you look at the Russell 2000, you will see that it's also up again also. And I think the Russell has more upside to go here. But before you get too optimistic, I want to show you something. Now, here's the chart of the S&P 500, all-time highs. Look at momentum levels, folks. The highest level we've had, this is the highest level we've had since 2009. That's the number of stocks trading above the 200-day moving average, 93%. And if you look at the 50-day line, it's at nosebleed levels too. So I'm telling you right now as we sit here, this is not going to end well for the SPY, and the odds are we're going to come down to the 50-day line or maybe even lower. The momentum levels are just too high in the near term, both the 50-day and the 200-day, especially the 200-day. This is like nosebleed levels. This is stretched out to the tilt. So I believe we're going to see some downside correction in the broader market. And if you look at the NASDAQ, it's following it right now. But the NASDAQ has been congesting and consolidating for quite some time. So we may see some more upside. But in terms of performance, I would rather bet on the small caps than the QQQ right now because of that interest rate sensitivity right now that you have in the large caps that you don't really have with the small caps right now. Now, in terms of what you should be looking at right now, if you look at the average, the cumulative strength average, you will see that consumer staples are now going higher. They are now, if you look at consumer staples, they're on the lowest spot, right, cumulatively. But look at it on a monthly basis. Consumer staples are now the third highest ones. Utilities are going up, and the highest performer is real estate over the last 30 days. And guess what stocks I have for you today? A bunch of real estate pullbacks. So again, over the cumulative, real estate is right here. But if you look at it, and consumer staples is in the last spot. But folks, with the market cooling off a little bit and bond yield rising, it looks like consumer staples and real estate may start going a little higher. So real estate is the fastest growing sector this month, followed by utilities, followed by consumer staples. And consumer staples and utilities, they always move. Now, what's interesting is industrial and basic materials have not lost their place, but technology is all the way in the last spot. So I would be careful with technology right now, especially the FANG stocks. Chip stocks, whole different world. So right now, the money's moving into defensive stocks like real estate, utilities, consumer staples, interest rate sensitive stocks. And right now, I've got some really, really good pullbacks, short-term pullbacks for you on real estate stocks. Look at this. IYR, look at this. Swing high right here. That's the iShare. Let me put this up here. It's the IYR. Let me put it IYR. It's easier to see it on these charts here. Look at that swing high. 1 year high, completely breaking off, way above the 50-day moving average, bucking the trend. IYR. That's the U.S. real estate iShare ETF. You get all your real estate stocks in one bank. How about XLRE? XLRE, look at that. Real estate, that's the S&P. That was iShares, this is the S&P. But my point is all the ETFs, all the real estate ETFs are making a 4x4 pullback and breaking up to new highs. Let me show you another one. How about, Realty Income Corporation. Are you starting to see a pattern here? Real estate. Look at this thing. It's not an all-time high, but it's definitely moving up. Look at this thing. Let's look if there's any more. Ooh, look at Sherwin-Williams. Paint. Remember what I told you about 6 months ago? Man, look at this stock. SHW. Whew. Duke Realty. Let's look at DRE. But I think real estate is a good place to focus on right now as we speak. Look at that. They're looking really good. So here's another one. FR, First Industrial Realty. Real estate, REITs, real estate, ETF, Schwab. So you got all the stocks making swing highs. IYR, XLRE, Realty Income Corp, Sherwin-Williams Painting Store, but that's a whole different world. Duke Realty, First Industrial Realty. Pay attention to real estate. Now, folks, before I let you go, I've got something big for you, something important. Now, I'm willing to bet that most traders don't know that there's a little-known rule. That's right, a little-known rule causing a glitch in the stock market. And those who can spot it have the chance to grab double, triple, even quadruple-digit gains overnight. That's what happened with KNDI when it saw a 2,340% gain. Folks, can you imagine waking up in the morning and seeing a 2,340% gain on your account? That's insane. Luckily for us, Wall Street legend and Forbes contributor Adam Sarhan, he's found the glitch and he's ready to share it with you all. Click on the link below to reveal exactly what Adam has discovered. And make sure to like this video, subscribe to this channel if you're watching on YouTube. Folks, stay ahead of the market by being the first to be notified when we post our next video. And again, luckily for us, Wall Street legend, Forbes contributor Adam Sarhan, he's found the Wall Street glitch and he's going to share it with you. Again, follow the link below to reveal exactly what Adam has discovered. And have a great week ahead and stay out of trouble. Check out those real estate stocks. There's something to it this week, especially with interest rate sensitivity. Bye, folks.